In this video, what we're going to try to accomplish is to try to figure out some downside targets for the S&P 500 if we continue to sell off, right? So if this sell-off that we have had for the last month and a half or so continues, we want to see the potential downside targets in the S&P 500. So it doesn't matter at what point in the future, guys, you're watching this video, these downside targets probably, because of the way I'm going to run the analysis, will not change. So I hope that you're watching this video, a year, 2 years in the future and learning from it, learning how to, do the downside analysis, right? Coming at this with an open mind, no preconceptions. We're just going to analyze the data and look at what the market is telling us. And for this analysis, we will be using stockcharts.com. That is the charting service that I use, and I do pay for this. I am not subsidized in any way by using their service, but I do want to point that out, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. So the first thing we want to do is let's just take a look from a moving average standpoint as to where we are currently at. And I'm going to drop in the 40-week, which is very equivalent to the 200-day moving average. It's not always exact, but it'll get us close. And it's a pretty standard moving average to look at, right? Kind of a longer-term moving average for the weekly charts, right, would be a 40-week moving average, again, fairly equivalent to the 200. And we can see here for the last couple weeks over here on the right-hand side where my cursor is moving, we can clearly see that the S&P 500 for the last 2 weeks has closed below its 40-week moving average, okay? So that gives us some perspective as to where we are currently at. So let's get rid of this, and I'm going to do an update there. And now let's bring up the annotations tool. And the first thing we want to do here is let's start off with a horizontal line. Now, we know from previous analysis that the 4350 level on the S&P 500 has been a very, very important support and resistance level. So I'm just going to change this. It's been a very, very important support and resistance level since clear back in June, right here, June of 2021, when we first got up to this level. And you can see once we hit that 4350, we kind of stalled out here for a couple of weeks. But once we finally got above it, then we were able to stay above it. And you can see that every single weekly close on the S&P 500 until this past week, okay, and again, I'm making this video on February 21st. Now, the market is closed today, right, for the presidential holiday, for President's Day. But, just to give you some perspective, but on Friday the 18th, right, the week ending Friday the 18th of 2022, we closed barely below that 4350 level at 4348.87. And that was the first time since July of 2021 that the S&P 500 has closed below this 4350 level, as you can see. Now, we only closed below 4350, right? Again, the close 4348.87. Hopefully, you're looking at this on a larger screen like a computer screen, but 4348.87, again, that's the close on Friday, February 18th. So again, first weekly close below 4350. I just want to, before we go any further, guys, it's really important to understand this, all right? So bear with me here. But that's only 1.13 points, right, to be really exact. It's only 1.13 points below this 4350 level, all right? So technically, did we violate it? Yes. Did we violate it by much? No. But again, it's over the last 30 plus weeks, that's the first time we have had any close below 4350. So it could be significant. Only time will tell, if the next few weeks, right, we'll close below that. But if, right, and so here's where we need to start, right? We know that this 4350 level has been a super important level. We've broken below it. So now, if the market continues to sell off, and there's definitely that possibility, right? and perhaps it's highly probable over the next few weeks. So what's the next downside target, and where might we go below that? Okay, so the 4,200 level right in here, right? There's some trading here. So let's pull up this annotation tool, and let's bring up really a box, right, or kind of a rectangle here, because what I'm seeing is this trading kind of right in here from back in 2021. All right, and so this really started, let's just save this box here for right now. So this really started back here in April, as you can see, of 2021, where we kind of got up to this level and kind of stalled down and went sideways. All right, so these are the types of things you're looking for. You're looking for these kind of thick areas where there's been a lot of trading as we went up, and so on the way down, those are very likely support and resistance levels. All right, so let me pull up this annotation tool again. We're going to get this horizontal line, and I'm going to draw a line kind of right in here, and what I think we're going to see here is that's right at, yep, that's right at that 4,200 level, plus or minus. All right, so if this 4,350 level does not hold, then the next possible area of support is right around this 4,200 level, plus or minus, say, 50 points, right? So maybe 4,150 to 4,250. There's kind of a thick area right there. So it would make some sense that that would be the next downside area. Now, the other thing to remember is on Monday, January 24th, we briefly touched the 42.22.62 level. So far during this downturn, and again, depending on when you're watching this video, that may still or may not be true. But so far, as of February 21st, 2022, when I'm making this video, the 42.22.62 level has been the lows of this downturn. All right. And that's right here. So we have checked back, right? We've checked back to the top end of this range, but we have not yet violated down. We haven't traded below, and especially we haven't had any, weekly closes right below 4,200. So, if we continue to roll over the next few weeks because of, the potential for an invasion into Ukraine and a host of other things that are going on around the globe geopolitically, as well as just, market movements, the Fed raising rates, anything like that, it doesn't matter really. The causative factors, guys, don't matter, okay? And we're never going to know all of the reasons why something happens. And that's, people will ask me all the time, what's the reason? It's like, guys, this stuff is just way too complicated. The markets are, the economy, the stock market, the geopolitics, there's way too many things, too many variables to know, all of the causative factors, right? So when we're doing this technical work, it really doesn't matter why something has happened. The fact that it's happened is what we need to stay focused on, okay? And so, again, 4,200 is the next possible downside. Now, let's do some more work here, and the first thing I want to do is I want to back up this chart, and let's actually back this up a couple of years. I'm going to change the start date to January 1st of 2019, and we will update that. And all right, so now we have a longer term perspective, and we know so far that 4,350 in this 4,200 plus or minus area is going to be very important. Now, the next thing we're going to do is we're going to bring up the Fibonacci retracement tool, because I have found, and guys, this stuff is just absolutely fascinating, right? If you're not familiar, or even if you're vaguely familiar with Fibonacci work, this stuff applies to the galaxies, to seashells. I mean, it's just absolutely amazing how this Fibonacci, these Fibonacci retracements work, all right, and their predictability, or at least consistency, I'll put it that way, over time. All right, now it's getting a little bit busy here because we have a lot of blue lines here, but bear with me, because this is so very important, guys. So the main numbers, and there's a lot of Fibonacci numbers, but the main numbers that we need to concern ourselves with respect to market analysis and potential downside targets are the 38.2 and 61.8% retracements. Those are standard Fibonacci retracement numbers of any move. All right, and I'll explain this a little bit more in detail, so bear with me. But 38.2% and 61.8% retracements are kind of the primary numbers we need to worry about. Now, a 50% retracement of a prior move in technical work is kind of a standard number to look at, 50% retracement. However, it's not a true Fibonacci number, all right? But 38.2, 50%, 61.8. So let's take a look. And what we're looking at here is the move that we had from the COVID lows in March of 2020 to the peak of the market back here. And I'm going to just tweak this just a hair because I can see that my where I drew this was off just slightly, but not by much. Okay, so let's drop it right there. All right, and a little bit more exact. Just not going to change it a lot. And keep in mind, guys, these things don't have to be exact, but they give you some areas to look at. All right, so what we can tell here by looking at the 38.2, 50%, and 61.8% retracements of the entire move from the COVID downturns March of 2020, where the market S&P 500 bottomed there, to where we peaked at the end of 2021 in December, what we can see is that if this 4,200 plus or minus a 50-point level does not hold, right? So the market continues to go down. We break below this 4,200 level. The next possible downside target would be right around 3,800, all right? 3801.80 is where that 38.2% retracement line lies. But anywhere around 3,800 plus or minus, say, 25 or 50 points, and you can see there was a little bit of trading right there. So that's a possible downside target. If that doesn't hold, then the next level that we're seeing, and look at how this lines up, right? This 50% retracement, which is just around 3,500, 3493.35 is exactly where that line lies, where we have it drawn. But look at how that hits right at the top of some of these weekly candles that we had back in August, September, and through October, right to the beginning of November of 2020. All right. So do you see how this makes sense, right? That these downside targets, it makes sense. And then we have kind of a thick area here where there was quite a bit of trading from the beginning of July of 2020 until the beginning of November of 2020 between the 50% retracement and the 61.8% retracement, which is right around 3,200, the exact number that's showing up here as we have drawn the lines, 3184.89. All right, so let's just call it 3,200. It's close enough. But you can see a lot of trading here. All right, so again, if the market continues to fall below 4,200 and we break below 3,800, then the next downside target would be around 3,500. If that doesn't hold, then 3,200, right? And you can see there's, and there's a lot of trading right in there. So it could stop anywhere right in here, right? And that would bring us down, if we retrace 61.8% of this entire move, that would bring us down to right around this 3,200 level. And that would be the top end of this right here. Now, what I have found in my technical work, and again, I've been doing this, guys, for decades, right? I'm a former financial advisor, former VP of a major mutual fund company. What I have found, and of course, I've made thousands and thousands of personal trades and, ran money for other people as well when I had my financial practice. But what I have found is that oftentimes the markets, and this is true for any time frame, and I know this is getting busy, but bear with me here. What I have found is oftentimes when we peak and pull back, the pullback will go down to somewhere around the prior peak. Now, the prior peak, of course, is before the COVID downturn, and that would have happened in February of 2020, and that prior peak was right around the 3,400 level, all right? And that 3,400 level, of course, lies in between the 50% and 61.8% retracement levels, all right? So if, right, we're pulling back, this would be another area to watch, would be the peak in before the prior downturn, right? Because again, I found this, and I found this on shorter term charts, longer term charts. It's not unusual at all for the market to pull back to the point of a prior peak, or even, go below it. But again, that makes this area right here, right, between 3,200 and 3,400, a really solid downside target. Now, I want to be clear here, guys. I am not predicting any of this, right? I cannot predict the future, nor can anybody else. We can speculate, we can make guesses, we can have opinions, but we don't know. There's too many variables. So I hope you see, and I hope you are learning that you come at this stuff, right? I hope you're seeing that I'm doing this, and I'm encouraging you to come at your technical work being completely neutral, right? Just looking at the facts and coming at it with an if this, then that mindset, right? Be agnostic, right? And the word agnostic outside of religion, of course, means that you don't have any preconceived ideas of something, right? You're neutral. You don't care. You just want the facts. And these are the facts, guys. This is where these downside targets currently lie, and these downside targets will not change, all right? I mean, this is what the data is telling us. This is what the markets are telling us. So right now, let's just kind of take a look at this again. And by the way, one more thing here. There's a very well-known guy named Jeremy Grantham who's been around for a long time. He's legendary as a value investor, and he's saying that 2,500. So I'm going to draw a line right here. 2,500 on the S&P is kind of the neutral point. I'm paraphrasing, but he's saying that 2,500 is a reasonable downside from here, and it's completely possible, right? I don't know how probable it is at this point. I hope it doesn't get that bad, but that is another, now he's just saying 2,500, right? There's some, and we'll maybe pull the chart back here a little bit more and see if we can, corroborate why he's saying this. But before we get there, I do want to point out that, another possibility, right, when you're doing these retracements is that you retrace 100%, right? If the top end of this previous high at 3,400 doesn't hold, if the 61.8% retracement doesn't hold, again, if this then that, right, is how we're approaching this, then 100% retracement of the entire move, in other words, round tripping from where we've been since March of 2020 is completely possible. I mean, we were there just 2 years ago. Why couldn't we go back there, right? It's possible. Again, I hope it doesn't happen. That won't be a lot of fun, but we already know we're trading below the 200-day moving average. We've got some, we've lost our upside momentum, and so we know that we have these other downside targets. But if these things don't hold, then it's completely possible that we, go all the way back to this 2,200-ish level, and the exact numbers 2186.32. Kind of hard to see, but in the lower right-hand corner, that's pretty much where that would end up. All right, so let's just call it 2,200. But Grantham is saying 2,500. So let's take this chart back let's just take it back another couple of years. And guys, I hope you understand this is not a fast process, right? And I hope you're enjoying seeing me do this work because this is what you have to do. Okay, when you're doing this type of analysis, and you just start playing around with the data and looking at Fibonacci retracements where some thick areas are on the charts, and get an idea, and it may not be exact, right? 3184.89 is the 61.8% retracement as we've drawn it, right? And I've gone from the not the body of the candle, but the tail of the candle to the wick of the candle, right, on these weekly candles over this entire move. You can draw the lines however you want, but it's going to get us close, right? 3,200 plus or minus 34, 3,500, 3,800, 4,200. These are areas where we need to watch. Now, if we look at Grantham's downside target of 2,500, you can see in that range, right, there's some trading right in here, right in here, right in here. So, the lower you go, the more likely these scenarios are going to hold up. But I think, right, and I'm going off of memory here, and let's go back a little bit further, but I think this 2,200 level actually, unfortunately, right, has even more support because, and maybe I didn't go back far enough here. Let's go back to, say, 2012. Let's just take this back a ways. And I did not save that. I apologize. Let's go back here. There we go. Okay, now I've got it. And let's take our annotation tool, and what we're going to do is we're going to extend out this 2,200 line, all right, because that we, of course, I'm gonna leave it right at 2,200, as close as I can get it there, okay? And even though the 100% Fibonacci retracement would take us down slightly below that level, as you can see. But the importance of this is when we pulled back during this COVID downturn, we pulled back again to the top end of this range. You see kind of this thick area from 2015, 2016. We just kissed, right, during the COVID downturn, the S&P 500 pullback and kissed the top end of that area. Do you see that right there in 2016, the summer of 2016, July, August, September, right in there, okay? So, maybe I'll just put an arrow right there, all right? So I hope you see how this stuff works because, when these pullbacks happen, you check back to the top end of that range, you pull back. And this is why I say this area here, right around 3,400, right, is not dissimilar from this because that was the top end of this range before we finally broke out of it, right? This was the top end of this range, before the correction and then up. So, somewhere in here is a very logical downside if these other support areas don't hold. And you can clearly see that 4,200 plus or minus does not have near as much trading as what the 4,350 level had. So 4,200 plus or minus will not provide near as much support as the 4,350 level has. The 3,800, some trading, but nothing like these other two areas. So, until we get down to around 3,500, there just isn't a ton, some, but not a ton of support. And the lower you go, think about it like taking a beach ball, and pushing it down underwater, like when you were a kid playing in the swimming pool, right? As you push it down, there's more and more resistance, right, as you try to push that beach ball underwater. And that's very likely what's going to happen here as we go lower. Each one of these areas, kind of like trying to push that beach ball underwater, is going to provide more and more potential support for the markets. But hopefully, guys, we're not going to round trip this entire move that we've had since March of 2020 because that would take us down to this 2,200 level or perhaps even lower, because you can see here that there's even more support when we get down to the 2,100 level, all right? And I'm just going to get that as close as I can right in there. And let me back out of here. All right, so as you can see here, right, once we get down to this, 2,200, 2,100 level, you can see that, we start to get a lot of support down in here. Again, guys, I am not trying to scare you. I am not trying to suggest that this is where we're going. I am trying to educate you on the fact that these are possibilities, right? These are possibilities. Now, let's take a look. We know we got up to 48.18 and change at the peak back here, all right? So what I'm going to do is I'm going to stop the recording for just a second. I've got my calculator here, and I'm going to calculate if we were to pull back from the 4,800 level, 48.18 to 2,200 or even lower. I'm going to calculate what percentage of a drawdown that is, and then the next thing we'll do is we'll go back to 2000 through 03, and then we'll look at 07 through 09, and we'll look at the percentage of drawdown that we had in those two bear markets, and we'll see, how realistic it would be, right, for us to pull back to this 2,200 level based on what we've experienced in the past on a percentage basis. So I'll be right back after I run these calculations. All right, so here is what I have found out, all right? So what I did here is I started at 48.18, and of course that's the high back here, was just a hair over that, the intraday high back on January 4th of 2022. So 48.18, and we're looking at the possibility, right? What is the, the likelihood, right? The possibility and what the percentage drawdown would be if we did a 100% retracement of the entire move from the COVID lows right here, and we're going to use 2,200 as that possible downside. That means we would lose 2,618 S&P 500 points. If you take 2618 divided by 4818, right, which is the high, that means it would be a 54.34% drawdown, right? As we move back down, that would mean we would lose 54.34%, right, to go from here to here. That would be a 54.34%. Now, 100% of the entire move, right? But it would represent a 54.34% loss of the entire S&P 500 from 48.18 down to 2,200. Now, I went ahead and ran the calculations that if we pulled back to this other peak, as you can see, there's clearly more support here. Again, I am not making predictions, But this is the top end of the range at 2,200. We check back to that during the COVID downturn, but if we were to fall back to a thicker area of support at 2,100, that would mean 2,718 lost S&P 500 points. That's a 56.41% drawdown from the peak at 4,818 down to 2,100. All right. So the question becomes, how realistic is it, if this is a serious downturn, if the markets are clearly overvalued, as a lot of people say? Again, I am not trying to make that prediction. We're just looking at the analysis and looking at possibilities, right, to protect ourselves, to educate ourselves. So if we were how likely, right? How likely? How often does this happen? Is it realistic, in a bear market to lose, 50 to 55, 56, even 60% of your value on the S&P 500? So what we're going to do now is let's pull up. I'm going to pause the video for just a second here, guys. I'm going to pull up another chart and get it set up for us so we can go back and take a look at those last two bear markets, and we're going to run some calculations from a peak to trough standpoint and look at how far the S&P 500 fell, and then we'll see if these are realistic possibilities. Okay, I'll be right back. Okay, so now what we're looking at here is a weekly candlestick chart of the S&P 500 that starts in 1999 and runs through the end of 2003. And I wanted this 5 years so we could really see what had happened. We see the run up into the peak of the markets at that point, back from 99 into 2000, and then we rolled down and actually hit the ultimate lows in October right here. End of September, beginning of October of 2002 right here, all right? So what we want to do here is, the first thing, we want to figure out the highs, the ultimate highs and the ultimate lows, all right? So I'm going to drop in the price labels, all right? And what we can see here is the market peaked right here in 2000 at 1553.11. All right, so 1553.11, and the ultimate low was 768.63 right here. All right, so I'm going to pause the video for just a second, and I'm going to write these things down. Right, we're going to type those in, and then we will run some calculations and see what kind of a drawdown that was, and it'll show us right from peak to trough, what that drawdown was. So I will be right back. Okay, so here's what we know. We know that the market peaked in 2000, right? We're looking at the 2000 through 03 bear market, and we peaked at 1553.11 right here in 2000. The low of the entire downturn was 768.63. That's the low point, and that was in the latter part, September, beginning of October of 2002. And so 1553.11 peak. The low point, 768.63. This means that we lost from here to here 784.48 S&P 500 points. That is, if you take 784.48 and divide that by 1553, that is a 50.51%, 50.51% drawdown from peak to the low point, right? From peak to trough. We had a little over 50% drawdown. We lost little over 50% of the entire value of the S&P 500 was wiped out in that matter of time. All right. So if we go back and look at the downside possibilities that we were looking at, right, could we get back down to this 2,200 level, right? That'd be 54.34% drawdown. And if we go down to 2,100, that would be a 56.41% drawdown from where we peaked at 48.18. It is a completely plausible drawdown, right? It's not that much more than what we lost in the 2000 through 03 downturn. So we know that that's possible. So now what I'm going to do is I'm going to do the same thing for the 2007 through 09 bear market. So I'm going to pause the video one more second. I'm going to get that chart set up, and we'll run through the same scenario, and let's see on a percentage basis how much we lost during that bear market. And again, we can use these last two bear markets, right, to compare to what we might see. So if it gets as bad as if the current scenario, right, if the drawdown in the S&P 500 on a percentage basis gets as bad as what we saw in 2003 or 07 through 09, we will have some realistic downside targets to keep our eye on. All right, guys, so here's what we have. This chart is a weekly candlestick chart of the S&P 500 that goes from 2006 through the end of 2009. So this, of course, encompasses the entire bear market, the housing debacle and everything we had going on there. And let's see what we found out. So we know that the S&P 500 peaked right here at 1576.09, and that was at the beginning of October of 2007. And then look at how fast this drawdown was, and we went all the way down to 666.79. That was the low of the downturn in March of 2009. So 1576.09 to 666.79, that is 909.30 lost S&P 500 points. If you take 909.30 and divide it by 1576.09, what that tells us is that from right here to right here, the S&P 500 lost 57.69% of its entire value, okay, in less than 2 years. So, going by the fact that here, right, in 2000, and it took about 3 years. I mean, it was brutal, right? This one lasted a long time. This one was a much shorter downturn, but much more violent, and we actually lost on a percentage basis more of the S&P 500. But the point is that, a 50 to 58, let's just call it 60% drawdown in a bad bear market, that is completely within the norm of, within the realm of possibilities. So, if we get, once we get down into this, we know we peaked at 4,800. Well, half of that is 2,400, right? So anywhere down in here would be that 50% retracement of the entire value of the S&P 500. So the analysis that we are doing here, guys, and I hope you see the value of this, starting at 48.18, if, right? And I'm not trying to scare you. I'm trying to educate you on numerous levels, right? That these, 50+% drawdowns, this is what a bear market looks like, a serious bear market. They are rare, but here's two of them in one decade, right? 2000 through 03, 07 through 09, and we lost 50+% of the S&P 500 in each of those downturns. So to think that this couldn't happen again or won't happen again is to be naive. All right, so this is what a bad bear market looks like. So, again, just to recap real quick here, 4,350, 4,200. I mean, we're right at 4,350 now. So if this doesn't hold, 4,200 plus or minus, and then we get down to this 3,800 range. If that doesn't hold, 3,500. We may have some support around 3,400. That is the peak of the prior move before we had the COVID downturn. And again, my experience is oftentimes we pull back to the peak of the prior move. If that doesn't hold, then Grantham is calling for Jeremy Grantham is saying somewhere around 2,500 is kind of that fair value. Again, I'm paraphrasing his and you can go out and probably Google it and find his recent interviews. But 2,500 ish is what Grantham is calling for. And if we retrace 100% of the entire move from the COVID downturn from March of 2020. To, if we retrace the entire move 100%, that would take us right around this 2,200 mark. Again, that is a 54.34% drawdown from our peak. And if we go down to the real support level that we had back in really started the latter part of 2014 through 2015, 2016, and this was brutal, man. It was horrible. I was managing money for other people back then. You just can't. It's so hard to make money in the markets, when the market's doing this, right? So if we pull back to this area here, that would give us that 56.41% drawdown, which is not quite, but very close to what we saw from 2007 through 09. Now let's go back and take a look at how simple market signals could have helped you in the bear market that started in 2000, that ended in 03, and then next we'll take a look at the bear market that started in 2007 that ended in '09. So in 2000, you can see that the risk signal, the market mode signal, would have turned red right here at approximately 1450 on the S&P 500. And this risk signal, the market mode signal, would have been red through the majority of this downturn and then turned green right here just under 900 on the S&P 500. So think about that. Any of you that lived through this, any of you that were invested in the stock market during this period of time, as I was, right? I was working for Oppenheimer Funds, the mutual fund company, during this time. But you can see here, guys, this huge drawdown, right? This hurts, and it lasted for several years, and it just felt like every time we were starting to pull out of this, something would happen that would send us lower, all right? And these types of downturns, these prolonged downturns that last years, they are brutal. But think about how much knowledge you'll have when the risk signal is red whenever we get to the next bear market, right? Whether it lasts a few months or a few years, when you know that that risk signal is red, you know what to expect, right? Losses are much more likely than gains, and so you can take the proper measures to protect yourself, and you'll have realistic expectations as to what is probably going to happen. But then when that risk signal turns green, you know that the likelihood of you making money has substantially increased, okay? Now let's take a look at the bear market from '07 that ended in '09, and you can see here that the risk signal would have turned red right here, right around 1500 on the S&P 500. And you can see that the risk signal would have been red for the majority of the downturn. We did have one short green signal right here that lasted 1 week, and then the market rolled back over. And so maybe you would have had a small loss here, okay? But that's just the way any type of protective system works, guys. But think about this. Again, you could have got out, or went to cash or done whatever you wanted to do right around 1500 to protect your portfolio, and you would have had a green signal that would have came out around 875 on the S&P 500 right here in 2009. So 2 of these types of downturns in the course of a decade, and simple market signals could have helped you really protect yourself and really understand what was going on in the market and set realistic expectations for you in both cases. And when the risk signal turns green, as it did right here, you will know that the likelihood of you making money in equities has substantially increased. Why is simple market signals so important? Because market risk is the single biggest risk most investors face. And market risk is non-diversifiable risk. Market risk cannot be diversified away. And future investing success will require getting in sync and staying in sync with the stock market by using stock market-driven data. Simple Market Signals is built around a multi-factor stock market-based model. I'm going to repeat that. Simple Market Signals is built around, based on, a multi-factor stock market-based model. Simple Market Signals identifies the current level of market risk, giving you the opportunity to stay in sync with the stock market. Now let me share with you what subscribers are saying about Simple Market Signals. First, we are going to hear from KT from Michigan. I have been trading for many years. I did not realize that I have been trading in a completely blind fashion. SMS has given me the direction, literally, I've been desperately needing. This service allows you to clearly see what the market is doing. If you are remotely serious about trading or investing, you must try this service. Again, that's from KT from Michigan. KT, thank you. I appreciate that feedback. Next, we're going to hear from SC from Florida. And SC writes, I manage my own money and I am not a professional, which could lead to a disastrous outcome as it has for many. Simple Market Signals is the equivalent of having a personal money manager that keeps you invested when it counts and alerts you to the potential dangers ahead. Now, I want to point out here, guys, I used to be a money manager. I sold my practice in 2016. So these are the exact words that SC from Florida wrote to me. So I just printed it as is. But I want you to understand, I cannot give advice but this is the feedback that SC from Florida gave me, so I appreciate this. So again, SC writes that simple market signals helps you stay invested when it counts and alerts you to the potential dangers ahead. The service is extremely affordable and takes the uncertainty and fear out of being in control of your own investments. I have done very well using this system and consider myself lucky that Rodney's YouTube channel came into view one day. I highly recommend this to anyone who desires an easy system to produce positive returns in the markets. Again, that's from SC from Florida, sent from his iPad. And guys, I want to point out the reason I'm using just the first and last initials is for the security of my subscribers, okay? I have hedge fund managers, very well-off, multi-millionaire clients. I have, people that are high up in various areas of the government. I have people from all walks of life. So just out of respect and security for my clients, this is the way that I'm presenting the information, just with their first and last initials as well as their state. Next, we're going to hear from FS from Massachusetts. Rodney is spot on in his reading of the markets. I was looking for a heads up to help me choose which side to use for vertical spreads. Again, that's from FS from Mass, and thank you so much, FS. I appreciate that. Next, we're going to hear from JV from New York. Now, I posed a few questions to my subscribers a few weeks ago, and this is the feedback exactly that JV from New York gave me with respect to the question. So I produced it just as he wrote it. So the first question, what do you like best about simple market signals? What JV said was, one of the things I like best about simple market signals is that I have an easy-to-use tool at my disposal. I use the green, yellow, and red signals along with the general trend to help me determine how much equity risk exposure I want my investments to have in the market at any one time. I will either increase or decrease my equity exposure based on those metrics. The next question, what is important about simple market signals to you? JV writes, I am a conservative investor. My main goal is to preserve as much capital as possible during market downturns, yellow and red signals, and to optimize my returns during green light conditions. The next question, how has simple market signals helped you? JV writes, SMS helps me to determine whether to stay the course, increase equity exposure, or take defensive positions. For example, I will add additional funds to my equity investments during green conditions and move money to cash during red conditions. And the last question, how have you benefited from simple market signals? JV writes, one of the benefits of SMS is that it has reduced the stress from always looking at and analyzing market conditions and worrying about it on a daily basis. And again, this is from JV from New York. JV, thank you so much for the feedback. I really appreciate that. There's two major components to the simple market signals proprietary model. There's the risk mode, the market risk level signal, and then there's the general trend indicator. Let's start off with the simple market signals risk signals. The simple market signals risk signals, the market mode signals, are simply green, yellow, or red. When the signal is green, this is when you're going to have your easiest, lowest risk profits, and this is when the market is generally in an upward market mode. When the signal is yellow, this is when we have a soft market, and the market is generally sideways to slightly up or down in a yellow signal environment. And what you're going to find is when the market mode or risk signal, right, you can refer to it either way, but when the market mode signal is red, the worst losses, including bear markets, are going to happen in a red signal environment. So when the signal is red, the market is generally in a downward mode. Next, let's take a look at the general trend indicator. The general trend indicator measures the trend of the stock market based on our proprietary formula. The signal is either positive or negative. When it's positive, we're in a upward general stock market trend. When the signal is negative, we're in a downward general stock market trend. Now let's take a quick look at a few market mode risk signal charts for the last few years. We're going to start off with 2018, and you can see here what I was talking about, that most of your upward progress in the stock market will be made in a green risk signal environment. The yellow signal is kind of a sideways to slightly up or down signal, as you see here. And then the red signal, right, this is just 2018. We'll look at a few more here in a second, but you can see the red signal here that we had in the latter part of 2018. And then moving on into 2019, we came into the year with a red signal, and then it went green, and you can see the progress that we make here. Yellow, correction, green, yellow, green, yellow, green. So you can see that most of the yellow signals go back into a green. The yellow is kind of a short pullback in a lot of cases, but as we saw here in 2018 and what you'll see also in 2020 is the yellow signal can be that transition signal between a green signal and then a red signal, as we see here with the COVID sell-off in February, March of 2020. And again, as we see here, right, most of the upward progress in the stock market is going to be made in a green signal environment. So think about this, guys. As long as the signal is green, you can see there's just not a lot to worry about, right? And even most of these yellow signals, this is when we get that pullback, but it gives you confidence in knowing what the market is doing. Now let's take a look at a few charts for the general trend indicator. And just like with the risk signal, we're going to start off with 2018. You can see we came into the year with a positive signal, had kind of a chop here where we went back and forth between positive and negative for a little while in February and March. We had an outright negative signal and then went back into a positive. But you can see here, right, this sell-off that we had in Q4 of 2018, we've already looked at the fact that that risk signal went red, and you can see here that we would have had a negative general trend indicator signal as well. And then you can see here when the signal is positive, this is when you get the most upward progress in the stock market. And this takes us into 2020. Of course, we had the negative signal right here during the COVID sell-off in February, March of 2020. And this takes us again to the end of August, beginning of September of 2021. And you can see here positive, very short negative signal, and then a nice long positive signal. And again, just like with the risk signal, I'm stopping the data at the end of August. And if you want the most current information, please become a subscriber. The signals are delivered to subscribers in our weekly video newsletter. In the weekly video newsletter, you will get weekly updates on our proprietary market mode signal. That's our risk level signal. And of course, you'll also get the updated chart for that signal each week. You will also receive the proprietary market mode risk level signal on all 11 major sectors of the S&P 500. You will also receive a weekly update on our proprietary general trend indicator signal, and of course, the updated chart for that. You will also receive market analysis on over a dozen charts every week covering all major areas of the stock market, including several international charts. So I'm going to cover small, mid, large. We're going to cover both a growth and a value ETF. I mean, guys, this is going to help you understand what's going on across the board. Of course, several charts every week on the S&P 500. We'll cover the Dow. We'll cover the triple Qs. So we're going to cover pretty much everything in there, okay? And so this is going to give you a really solid base every week as to what's going on in the stock market over and above our proprietary information that we're sharing with you. And then depending on what's going on, there will be occasional bonus material, not necessarily every week, but occasional bonus material, and this will be anything additional. From week to week, these things will vary, but these will be important and timely things that I feel that you guys need to know at the time that the information is delivered. Okay, so that'll be the occasional bonus material. To be fair to myself, I should be charging $97 per month or more for this information. However, you're going to get everything for just $19.99 per month. That's less than 67 cents per day. And to become a member of the channel and get access to the Simple Market Signals information, you will need to go to the Rodney E. Constable Stock Market channel. So depending on how you found the video, you may or may not be there, but you need to make sure that you go to the Rodney E. Constable Stock Market channel, and then you're going to click on this join button. Now, if you're not signed into YouTube, you will need to sign into YouTube. All right, and then once you're signed in, then you'll see this box pop up, right? Get access to exclusive perks when you become a member. So you click on the join button and you will see the information here, what you're going to get with your subscription, of course, your membership. And then you click on the join button and you want to add your credit card information. So as you can see here, you can pay with either a credit or debit card. Enter your card number, of course, the month and year of expiration, security code, cardholder name, and your billing zip code. So I'm going to fill all of this information in, and I will be right back. So once you hit that buy button, which is in the lower right-hand corner of that box, that previous box, you will then get this pop-up. Welcome. It's great to have you as a member. So then you can click on the See Perks. So once you fill all that out and your membership is established, then you will have access to the membership area where you will be able to see the perks, right? And then you go over to the community tab, and this is where you will have access to the various videos, and you just click on those and it'll pull those up. Okay, so I'm going to back up here, and so this is where all the training videos will be, as well as the weekly updates to the Simple Market signals that will be under the community tab. And that's all it takes to become a member. It's quite simple. And you will have easy, convenient access to this information. Everything is on YouTube in the members area of the channel, and everything is in video format. There's no emails to mess with and no websites to log into other than, of course, YouTube. So just to review the membership details, the video membership to Simple Market Signals through YouTube is $19.99 per month. That's less than 67 cents per day, and it's billed monthly on your credit card, or you can pay with PayPal. There are no contracts. You can cancel anytime, and if you do cancel, your membership will remain active for the balance of that current month, right, for that prepaid period, but you won't be billed for the next month. All memberships are controlled by YouTube, so if you ever have any question about anything, just Google it, and the answers should be out there. Some of my clients tell me they make tens of thousands of dollars per year from the information they learned from being a client of Simple Market Signals. It's not often you have the opportunity to invest a few $100s per year in yourself and potentially pull out thousands or tens of thousands of dollars per year from that tiny investment. This year, give yourself the gift of financial knowledge that can bring you big rewards over your lifetime. Now let's recap what you will get as a member. As a member, you will receive the weekly video newsletter, which includes the weekly update on the proprietary market mode, also known as risk signal, on the overall U.S. stock market. You will also receive the weekly update on the proprietary market mode or risk signals on all 11 major sectors of the S&P 500. You will also receive the weekly update on the proprietary positive negative signal for the general trend indicator. You will also receive weekly market analysis on the overall market, and there's generally 12 plus and sometimes more than 20, right, depending on what the information I need to disseminate, but there's generally at least 12 plus charts every weekend covering all major areas, right? Small, medium, large, growth value, all of that, including several international charts. But all of this is over and above the proprietary risk signals. So the weekly market analysis alone, guys, is worth far more than the $19.99 a month that we're talking about here, okay? Plus, you will receive occasional bonus charts as deemed necessary and appropriate for whatever's going on in the markets, all right? So that's bonus material that I do throw in from time to time, and that can be extremely valuable to you. Plus, you will receive special midweek updates when warranted. So again, if there's something going on in the markets, if there's a signal change in the middle of the week, we will put out a midweek update video so that you can stay current on the information. We'll get that out as fast as necessary, okay? And you'll also receive access to the growing video library of best practice educational videos that are part of your membership, and that will continue to grow over time, all right? Again, you're going to get all of this for just $19.99 per month. That's less than 67 cents per day. So join now to start benefiting immediately from this valuable and potentially life-changing information.